All right, let's get right into it. The silver market just went through an absolute roller coaster, a real bloodbath that shook a lot of people out. But the big question is, was that the end of the bull run, or was it actually the beginning of something new? In this explainer, we are going to break it all down, the technicals, the psychology, the money flow, to find out what really just happened and why the number 75 might just be the most important price in the world right now.
And for a lot of traders, it really did. We all watched as silver took a nosedive from an all-time high. It was a terrifying freefall that just vaporized billions in paper wealth. The mood, it went from total euphoria to absolute panic in just a few hours. The media started writing off the silver bull run completely, and you had traders everywhere wondering if the dream was over.
But amidst all of that chaos, I want you to look very closely at this single number, $75.32. That was the low of the day. That was the exact point where the selling just ran out of gas, and buyers stepped back in with, overwhelming force. And as we're about to see, this number is no accident. It's a calculated line in the sand.
So that really is the central question we're digging into. Did we just witness a catastrophic market crash, or was this something else? Maybe a violent but totally necessary consolidation that has actually made this market even stronger. To find out, we've got to look at the data.
What's just wild here is the sheer speed of the change. The drop from over $83 down to 75 was staggering, for sure, but the shift in sentiment, that was even faster. This rapid jump from FOMO to outright fear is exactly what separates the weak hands from the strong hands in a market, and that's precisely where the opportunity was created.
Now, let's be clear, that $75 level wasn't just some random number where buyers happened to show up. It was a predetermined technical fortress, really. It was built on three core principles of market structure that the biggest players, the smart money, were watching like a hawk.
Okay, so the first principle is something called polarity. If you rewind just a few weeks, $75 was the ceiling. It was that tough resistance level the market fought with for weeks before it finally broke through. Well, according to this principle, once that ceiling is broken, it flips and becomes the new floor. So the drop we just saw, that was a perfect textbook retest of that breakout level.
The second principle has to do with the algorithms, the machines that execute the majority of trades today. See, these algos, they don't have emotions. They just trade based on math. And one of their most important tools is Fibonacci retracement. It calculates these statistically likely points where a price correction might stop. You can think of them as pre-programmed support zones where automated buy orders are stacked up and waiting.
And this is where it gets really telling, because this chart shows you just how strong this market truly is. The shallowest, most aggressive Fibonacci support level was calculated at $74.80. But look, the price didn't even get there. It bounced more than 50 cents above that line. That is a massive sign of demand. Buyers were so eager to get in, they started buying before the price even hit the very first algorithmic target.
There's actually a name for this. It's called front-running the mean. So the 20-day moving average, basically the average price over the last month, was sitting around $73.50. But institutional buyers, they were afraid of missing the boat entirely if they waited for that fair price. So they paid a premium. They put their buy orders in at $75 to guarantee they could get their hands on a position.
Okay, so if the charts show a calculated defense, the next obvious question is, who was doing the defending? While so many were panicking and selling, a very different kind of market player was methodically buying. Let's follow the footprints of this smart money.
This really illustrates that classic transfer of wealth that happens in markets. On one side, you have the weak hands. These are often retail traders, and they're driven by emotion. They buy the euphoric top because they're afraid of missing out, and then they panic sell the drop. But on the other side, you have the strong hands, the institutions, the industrial users, and they do the exact opposite. They operate on logic, not fear. They waited patiently for the price to come down to their pre-planned technical level, and then they just calmly absorbed all the selling from the panicked crowd.
And the proof that they were buying is now flashing all over the charts. First, we got a hammer candle. That's a classic reversal pattern that shows the market strongly rejected lower prices. Second, the RSI, which measures market momentum, bounced at a really high level of 65. In a strong uptrend, you want to see momentum stay in this bullish zone. It shows the underlying strength is still there. And finally, you saw selling volume just dry up at the lows. There was literally nobody left to sell.
So the key takeaway here is this. What we all witnessed was a massive transfer of ownership. Data from the major silver ETFs showed that while retail traders were dumping their shares, huge net inflows were coming from institutional funds.
This wasn't a crash, it was a changing of the guard.
But this defense wasn't just about lines on a chart. There were actually three powerful fundamental forces that all came together at this exact price point to create a rock-solid floor of support. Let's break down these three pillars. First, you have the psychological power of the number 75 itself. Holding that big, round number keeps the whole bull market story alive. Second, the market has already priced in the worst-case scenario when it comes to China's new export rules. That fear is already baked into the price. And third, and this one is huge, you have the industrial safety net. Manufacturers who absolutely need physical silver saw this dip as a discount, a critical chance to buy before those new rules kick in.
And I love this quote from the source material because it just nails it. When you combine that technical defense with the psychological and fundamental pillars, the support down at $75 isn't fragile at all. It's a structural fortress. However, we have to be objective here. Even with this powerful defense, the market is not completely out of the woods. There are some immediate macroeconomic risks that could still crack this floor. It's kind of like we're standing on a trapdoor.
So here are the three main landmines to watch for. First, if the Federal Reserve minutes come out hawkish, it could send the US dollar soaring, which is usually bad news for commodities. Second, tied to that, if the US dollar index, or DXY, breaks above the key 110 level, it could act like a wrecking ball for silver prices. And finally, there's the outside chance that China's new export policy is unexpectedly weak, which would take some air out of the supply squeeze narrative.
So here's the bottom line when it comes to risk. The technical battle, well, that's been won. The $75 level held firm. But now, the market is facing a macro battle. If it can navigate these immediate threats, especially from a strong dollar, then the path of least resistance looks to be significantly higher from here.
And that leaves us with the ultimate question. We've seen an incredibly powerful defense of the $75 level, and it's backed by technicals, smart money, and fundamentals. But with these big macro risks still out there, we have to ask, was this sell-off the creation of a new launchpad for the next leg higher? Or is it just a temporary floor on a trapdoor that's about to spring open? The next few trading sessions are going to give us the answer.